Gonna be flipping my flapjacks, folks. It's supposed to be like a little off season for me right now. We're not in earnings season, but yet I'm having to record videos in hotel rooms in the desert. I'm preparing videos on a drive through the middle of the desert. I'm like, getting up at 5 a.m. every day. Here we are, folks. We got massive moves in the stock market. One of the first things I want to discuss here today is I want to show you some very important things that Charlie posted out there on X. And I thought this was very important if you want to understand where the market's headed over the next 3 months, 6 months, 12 months, year, 3 years, those sorts of things when we're going through the sort of market we're going through right now, okay? From there, we'll talk about this Elon Musk situation. That's a whole situation in itself, okay? From there, I want to talk about Morgan Stanley and Mike Wilson, because Mike Wilson actually just went on CNBC a bit ago, and so I want to talk a little bit about Mr. Mike Wilson and Wall Streeters in general. From there, we're going to talk stocks, and we got a lot of stocks to talk about in this video here today, and the market moves and everything going on there, which is obviously a massive flip that happened in the market here today, okay? From there, we're going to react to Tom Lee, who went on CNBC this morning, share my opinions and perspectives on what he said. Ray Dalio, same exact thing. He went on CNBC a few hours ago. Going to go ahead and react to that one. Looking forward to getting that one. Mr. Big Short, Steve Eisman, his perspective on this market. Dan Niles, we got all the heavy hitters out there in the past 24 hours that have gone on CNBC. Dan Niles on where he expects his market to head, and I'll react to that one, share my opinions and perspectives. And then Adam Pitapaka, we're going to react to that one in his opinions on where this market's headed, earnings, guidance that will be coming. And keep in mind, earnings season is already about to kick off again, folks. Literally, it's about to kick off again. Like literally, bank earnings start coming in the end of this week. And next thing you know, we're going to start getting a gauntlet of earnings, especially if you look out 2-3 weeks from now. Oh my gosh, it's going to be earnings madness again. So we're going right from a earnings season into a stock market crash into earnings season. Busy times, folks. All I need from you is one thing and one thing only. I hope you can do it for me. I need a thumbs up. That's all I need. I just need a like. That's all I need in this life, okay? And if you want to subscribe here to the channel, you can certainly subscribe. I think we're close to 90,000 subscribers here on the Reaction channel. I appreciate y'all for being here as always, okay? And additionally, if you want to apply to join my private stock group, private wealth group, get access to my private Discord chat, access to 1000xstocks.com. We can bundle all that together. Pin comment down there, click on that, fill out a form. Let's get you rolling. Let's get you taking this market more serious, because these are the sorts of time periods. If you're not buying during this time period, if you don't know what you're doing, you forever look back like, oh, remember when the market was crashing, I didn't buy? Remember when that stock was this price? And then a few years go by and you're like, what a mistake, because then you end up missing out on tens of thousands of dollars, hundreds of thousands, or millions of dollars, depending upon how much you could have invested during that crash. And that's what happens every single crash, right? Now, where I want to start here today is a very important place. Very important place, because 12 days ago on the main channel, I put out a video. And this video actually got the least views of any video I had put out recently at that particular time on the main channel, but it was such an important video on a psychological level. And let me explain why. That video was my warning to all investors. They're about to exhaust you. And the reason I made that video, and if you will go back and watch that video, I let you guys know that this is the stage of the market, essentially, where they're going to absolutely exhaust you. And what happened today is the most perfect example. Market massively green market, right? Everybody's portfolio is moving up substantially, gets everybody feeling like, oh man, maybe we hit a bottom, like maybe we're finally actually moving up, all to see, boom, whole market flip. Red Dead Redemption. And then people say, oh my gosh, the Dow was up 1,000+ points. The Nasdaq was up like 4-something%. The Russell was up huge, S&P 500, and we lost it all. White House comes out with new comments a couple hours ago. Hey, whatever you guys thought was happening, it's not happening. Tariffs are going on China, and boom, market just tanks and tanks and tanks, right? Which gives definitely a perspective of some out there that it feels like the White House is doing everything in its power to crash this market. Like the market's finally having a green day, and then the White House is like, no, you're not going to be green. You're going down, baby. And, they start talking to reporters and saying, no, all these tariffs are going on. Nothing good's happening. It's all bad. And all of a sudden, next thing you know, market down huge, right? Which is exactly the point I was making in that video. If you go back and watch that video, they're trying to exhaust you. This is the stage of the market where they exhaust you. This is the stage when bulls start to throw in their cards. They start only seeing things negative. They start saying, it's not even worth it buying the dip. Why would I buy the dip right now? We're probably just going lower anyways, because look at the stock market just goes lower every time. They start saying, look, one day we're finally going to have a green day, and it still goes red. That's what they start saying, right? And so it's very similar to the latter stages of a bull market. In the latter stages of a bull market, essentially, what happens is even when you start getting a red day, throughout the trading day, the market, next thing you know, will finish green. And so that's when FOMO starts building in the market, because people start saying, what is the point? What is the point of even trying to be bearish on this market? You can't be bearish on this market. It just goes up every single day. And that's when the bears start to capitulate and say, oh, this market's brutal right now. Every time we try to bet against it, the market just goes higher and higher. Every time we think we're going to make money, it just goes higher. Now we're on the flip side of that. We're on the market where the bears seem to just win every single day, and the bulls can never get a break, right? And that's a market that exhausts bulls. But you got to understand, as I pointed out, I think earlier on X today, I'm not sure if you guys follow me on X. I always have that linked in the description if you want to follow me on there. I said something very important. I said, the market that scares me the most is not a market, not a bear market, a market where you're going down, not a crashing market. That's not what scares me the most. Do you know what scares me the most? It's missing out on the upside markets. Because when you go and you look at the upside markets and how insane the moves are in the upside markets, it so far dwarfs the downside markets, it's not even funny. So if you want to talk about the tidal wave is the upward markets. The little waves are the bear markets, the crashing markets. And so I never am scared of going through a crash market. I'm never scared of going through a bear market. That's just part of the process. What I am scared of is not buying heavy enough during a crash. And then we go through a next massive bull cycle, which many times those last years. Bear markets, a lot of times, they'll last a few months, maybe a quarter or two. A long bear market is like if it lasts like a year or two. That's like insanely long. Like if a bear market goes for a year or two, that's really long bear market. Bull markets, like a little bull market, when it comes to bull markets, a little bull market will still last several years. But a big bull market will last 7-10 years, folks. 7 to 10 years. That's what scares me. Missing out on that opportunity, right? And so just always understand that, because that's the crazy opportunity out there. Now, I want to show you guys something very important if you want to understand kind of forward returns for the stock market, given certain market dynamics. So Charlie on X posted a couple really valuable things in my personal opinion, okay? One thing Charlie posted was this one: biggest 3-day VIX spikes in the forward S&P 500 total returns. This dates all the way back to almost around the time I was born. I was born in 1989, right? So we're talking almost my entire life. Not my investing life, which started in 2008, 2009, right? This is almost my entire life, all the way through recently. And what we witnessed here is a VIX spike to 100+%. Now, what do you see the forward returns being over the next number of years? Almost every single time, the forward returns are phenomenal. The average, right, average 3-year forward return is 39.5% for the S&P 500. That's the average, 39.5% 3-year return. The average 5-year return is 56.4%, or the average 4-year return is 56%. The average 5-year return for the S&P 500 after going through that period is 74.4%. 74.4%. That's insane, right? If we look back at the, a VIX spike of 80, we only have really one time where the 2-year and 3-year returns weren't good. And that was in 2007, right? You had a VIX spike to 80, so not nearly as high as we're at right now. But you had a VIX spike to 80 there, and the 2-year return, by the way, the 1-year return was still positive, but the 2-year return was down 45%, and the 3-year return was down 15%. 4-year return was up 2.9%, 5-year return was up 8.9%. That's the only time period, right, that you could look at and say it was kind of a rough next couple of years there. Every single other time was positive and pretty much insanely positive. So the moral of the story is here, folks, that when the VIX spike's huge, you better be buying because the returns are going to be insane. Next up here, Charlie also posted this. I thought this was phenomenal, okay? S&P 500 biggest 3-day % declines in forward total returns back in all the way up to 1950, all the way through 2025, right? And so here you are, you got a 3-day over 10% down, right? Which is a massive number. But check it out. Check out the 1 year, 3 year, and 5 year returns after going through one of those time periods. There's not one there that is down. Every single one is up. It's just a question of how insane up it is. The 1 year forward returns, look at some of these years. You're talking about 28% return, 24, 21, 69%. This is 1 year forward returns. 44%, 28%, 40%, 44%, 64%, 28%, 9%, 11%, and 1%. The worst one was a 1% gain a year later, right? And look at the 3 year returns. I mean, you're talking about returns on a 3 year basis of anywhere from 18% on the lowest end to, on the highest end, 3 year returns, 84%. 5 year returns after going through one of those massive declines. The lowest return was 13% there in 1998, right? Because then you had the popping of the tech bubble, so that went through into 2003. The best return profile over that time was 160% right there. But many of those time periods, look at it, like almost always you get a triple digit return over the next 5 years. Triple digit, and that's an S&P 500. So that means there's going to be some stocks that perform 400% returns, 500%, 800%, 1,000+%, 10x type opportunities in a market like that, right? So the moral of the story is, and why I wanted to show you guys these posts from Charlie here is, like, this goes to show you better be buying, right? Next up here, you got to understand what this means for Tesla stock and what this means for the market, right? So Peter Navarro went on CNBC and he talked about Elon Musk and Tesla. They're not a car manufacturer, they're a car assembler. And he, basically said a lot of their stuff comes from other countries and they just kind of, finish the product essentially in the United States of America, right? Well, Elon Musk did not like this. Elon Musk said just a bit ago, he says, Tesla has the most American-made cars. Navarro is dumber than a sack of bricks. Now, this is huge because Elon Musk is obviously insanely influential individual in this administration, as we know, running Doge and his opinions and perspectives. But Peter Navarro also is an insanely high-ranking individual for the Trump administration. I've never seen this. There's certain things that happen in the market that you've never seen before. I've never seen it where two insanely high-ranking members of an administration are going at each other's throats. And that's what's happening here. He says, Elon Musk says, by any definition whatsoever, Tesla is the most vertically integrated auto manufacturer in America with the highest percentage of U.S. content. Navarro should ask the fake expert he invented Tesla. Then he calls him Peter Retardo. Oh my gosh. Oh goodness. Insane. You've never seen this. There's no administration we could look back at in history where, publicly they were going at each other's throats like that. I mean, Elon Musk just called an insanely high-ranking person in the administration that he's part of. He called him retardo. Like, holy smokes. This ain't no dang joke, because you got to be flipping my flapjacks here. Now, it was interesting because Elon Musk decided to take it there because he had kind of tested the waters, I guess, a couple days ago, and I missed this. But essentially, Musk, had already had a problem with Navarro. And he said, Musk said, a PhD in econ from Harvard is a bad thing, not a good thing. And I guess he ended up deleting that tweet and whatnot, or post, whatever you want to call it on X nowadays. But, this is what adds to the market uncertainty right now. When you have high-ranking individuals in an administration going at each other's throats, publicly, almost humiliating them, whoo-wee! Like, the market does not like this type of stuff. This freaks people out. They're like, these guys can't even get along. And we're in just a multitude of bad looks right now because you got the whole tariff situation. The numbers were ridiculous. Like, experts have gone through and tried to calculate it, and they're like, it's ridiculous the way they try to calculate those numbers, the board that Trump had up there. Then you had, was it Besant or whoever go on media, and they ask him, what's the tariff rate on China is going to be? And he's like, I believe so. You believe so. What? You can't just say I believe so. It's either you know so. Like, yes, that's going to be the number that's on them. Like, I think it's going to be the number. Dude, that just makes everybody say, like, are you guys just throwing numbers out there? Just picking numbers out of your booty and throwing like, what is going on? And this is what is just causing massive panic in the market, because people are looking out there and like, what is even going on? The people running the show don't even know what's going on, and they're at each other's throats, and it's infighting and everything, right? So we got a whole situation going on there. How all this shakes out, I don't know. My guess is Elon Musk will get his way in the end. Elon Musk has a way of getting his way, okay? I also believe Elon Musk is likely closer to Trump than Navarro is. And so I also think Elon Musk is much more influential than Navarro is. And so therefore, I believe Elon will likely end up getting his way, but it's a mess, man. And this what leads to more market uncertainty, right? And the market feeling uncomfortable. Now, next up here, they had Mike Wilson on just before I started the video, so I wanted to include this because it's interesting. Mike Wilson went into 23 so bearish. Oh my gosh. I mean, every time he would go on any network, CNBC, Bloomberg, gosh, he sounded bearish. Same thing going into 2024. And then he flips recently and goes to the bullish side. And Morgan Stanley raised their base case. This was their base case. This wasn't their bull case. This was their base case for the 2025 year-end S&P 500 target to 6,500, right? 6,500. Where's the S&P 500 today? Let's go ahead and take a peek here, because I would love to see where the S&P 500 is. S&P 500 is 5,000, and it's barely clinging on to 5,000. Oh my gosh. Oh my gosh. So, and they're at 6,500 for their base case. I mean, let's be honest. There's a very low probability that base case is going to happen now at this point in time, right? And it just cracks me up, because I'm just like, this man was so bearish for so long. He didn't hold out on his bear case. Then he finally flipped. You know, he was bearish in years that was horrible to be bearish. Like, let's just be honest. Like, if you were in the market in 23 and 24, you made a fortune. Did you not? Like, you should have made a fortune. If you were in the right positions, like, you should have been making bank. There's no doubt about that, right? Like, tremendous years. Some of my best years I've ever had in the market was 23 and 24. Banger years. My gosh. And you know, you got somebody like him that flips over the bullish side. That should have been a telltale sign of like, oh, we're going to crash, because the bulls have, the bears have even capitulated over the bull side, right? We're done ski. Then at that point in time, which leads you to kind of say, hey, if you want to know when this bear market's likely actually for real done, it's when all the bulls, the biggest bulls, capitulate, right? The Tom Lees of the world, the Dan Ives of the world, those sorts of folks. When they start issuing, you know, more and more apology letters and they can only see the downside, that's when we're probably going to flip to the other side, right? You know, when those folks even start to throw in the cars, which is going to be interesting, because we're going to get to Tom Lee in just a moment here, okay? Now, looking at the market here today, you know, obviously Red Dead Redemption out there. It's not like that ugly of a day, but it is that ugly of a day. When you have a day where the Dow's up like 1,000+ points, right? Which, you know, let's go ahead and pull up the Dow here. And by the way, RH stock, look at this. This is less than the past, look at this stock. Since like January 21st, 66% down. But what makes a day like today so brutal is not the losses in stocks necessarily. It's the fact that this market blasted higher, right? I mean, this market was up, you know, where we closed yesterday-ish, 37.7. And the market was up like 1,500 points, right? 1,500 points. And it's lost it all now. The market's up 3 points. And it was up 1,500-ish range earlier. Oh my gosh. It lost it all. It lost it all. That makes for a very brutal market, right? In regards to people that are hoping for a short-term bottom here. Right now, us that love buying stocks at great prices, we're gladly welcoming this, because it just means, you know, my next buys are likely, I might buy some stocks tomorrow if the market goes down again. I might buy some today, actually. But I always buy stocks every Friday. A lot of us are looking like, give us more time. Give us more time to accumulate, right? Unless you're retiring tomorrow or next week or next month, you should want stocks for as cheap as prices over the next day, week, month, 3 months, 6 months, year. Because why would you want them higher? Like, why would you want stocks higher right now if you're not retiring right now? It doesn't make sense. Like, you want stocks for as low as price you can get because that just means you're going to make way more money long term. It's just as simple as that. The higher the market goes, the more it pulls forward returns from you. The lower the market goes, the more it gives you great opportunities for long term, right? So, looking at a stock like RH here today, that one was up huge, but yeah, I think that was just positivity based upon RH CEO went on Kramer Friday afternoon. A lot of people got excited about that. Stock sold right back off, right? 7+% down here today. Else just a ridiculous opportunity. Whirlpool's calling my name. I can't believe I want to buy an appliance maker so bad, but I really want to buy Whirlpool so bad. There's only one stock I want to buy as much as that in terms of stocks I don't have a position in yet. The other one's Adobe, ADBE. Adobe's another perfect example of a stock that I want to buy so bad right now that I don't have a position in. Adobe and Whirlpool. Both of those, I'm like looking at both of them. I'm like, oh, I want to buy both of those so bad, and I don't have a position yet. But we'll see. We'll see what happens there. Whirlpool's just had a brutal past few years. Look at where the stock was when, when a lot of people were moving. Whew, and look where it is now. It's down almost 70%. And that's the sort of market we're in, right? I understand just recently we went into bear market on the Nasdaq and the Russell and whatnot. But if you look at a lot of these stocks, and honestly, they've been in a bear market, a moving bear market for years, right? Really, it's just like the AI type stocks that have really helped out the market returns immensely in 23, 24, and the bounce back of big tech, right? That's really what helped the market returns look phenomenal in 23 and 24. But you look beneath the surface at anything really not big tech related, you don't have a lot to show for it. Or non-AI related, a lot of these stocks are just performed horrible for years. They've been in a multi-year bear market. Like, they've been through their own great financial crisis. And you can't say they haven't. When you got a stock down 70%, it's in its own bear market, right? EL's another perfect example of a stock like that. Look at EL stock. One of the best cosmetics companies in the history of mankind. This stock has fallen 83%. If we look at from those highs back at late 2021, stock's down 86%. And we're talking almost a 90% downward move for EL. One of the best cosmetics companies, beauty companies in the world over the last many decades, down almost 90% now. Almost 90% with some of the most successful, best brands in the world. We've been in a stock market crash. It just didn't show up. People just didn't realize it till recently. But many of the best companies that you would look outside of big tech and outside of AI, their stocks have been crashing for years now, just to be quite frank, right? And this just feels like the last hurrah sell-off for a lot of these stocks, where you just, it's just that brutal capitulation and just like, my gosh. Nike, same exact situation, right? Nike's been in a multi-year crash, right? 67% down. My gosh, brutal. See Bath and Body Works. Bath and Body Works, 62% down. Looks to me like these stocks have been in a crash, right? I mean, that's insane. Absolutely insane. Where's ELF at now at this point in time? ELF's still up 56% from there, but obviously ELF is down 1.5 miles from where it was, just shortly over a year ago or so. If we go back here, ELF's down 76%. Stock market crash, right? MU's down to 67 now. Oh my gosh. Look at a stock like Trade Desk. Oh my gosh, has Trade Desk gone through? Oh my gosh. Let's look at Trade Desk here from where it was just a few months ago. This is insane. This is absolutely insane what has happened to Trade Desk. Trade Desk down 66% just from where it was back in December. Wow. Incredible, right? And listen, you're in a stock market crash when you see all these very famous stocks these are great companies. I understand people trash them right now because their stock prices are down right now. Bath and Body Works and Nike and Estee Lauder and, who did I just show here? Trade Desk, all these companies, Whirlpool. But let's be very clear. These are some of the greatest companies in the world the last 30, 40 years. And their business models are still going to be just as relevant, if not more relevant, 30 or 40 years from now than they are today. And yet their stock prices are down 50, 60, 70, 80%. You're in a stock market crash, right? It's just what it is. So, and I understand, once again, people crap all over these stocks when you're in a down market and the stocks are down this much. I witnessed it. People were calling NVIDIA a garbage stock in the second half of 2022. A garbage stock. 2 years later, people were FOMOing over to buy NVIDIA at a $3 trillion market cap. Oh yeah, it's garbage. Oh yeah, it's garbage. Okay. Meta. They were calling Meta garbage under $100. Trash. They can't do anything. Zuckerberg's failure. Blah, blah, blah. And then they were trampling over themselves to pay $700 for it just a few months ago. And they weren't willing to pay $100 for it before. So, whenever you're in one of these markets, people just start calling stock, oh, that's trash. Oh, Nike's trash. Oh, this is trash. You don't know what you're talking about. I don't know whatever the way to put it. You want to call these companies trash? You will be buying them a few years from now at a much higher price. Not like a little bit higher. No. You're going to be paying 3x, 4x prices. And you'll be the same person they'll be gladly paying those prices in. You'll be like, oh man, look at how good their numbers are. Wow. My gosh, look at such a good company. It cracks me up. Every time. It never fails. Never fails. Right? Same thing again and again and again. Never fails. So, moral of the story is you better be taking advantage of deals out there. Where's VIX at today? Let's go take a look at that VIX, because today's another very volatile day. I mean, you want to say make VIX great again? VIX has been made great again. Oh my gosh. VIX hit another 50-ish range today. Oh my gosh. Look at that. We've got volatility, folks. Yeah. Make VIX great again. Volatility is great again. All right, let's start reacting to videos here. Tom Lee up first. Tom Lee.
A new note to investors. Fundstrat head of research, Tom Lee, saying, we want to apologize as the terms of the tariff liberation day were far worse than we expected. Tom Lee is a CNBC contributor, and he joins us now. But Tom, when you try and do direction and duration in the same way, we always go, I don't know how you expect to do that. So in this point, at this time, you didn't really anticipate that formula, I think, that was going to be used to arrive at such high tariffs. Kind of maybe got blindsided by that to some extent. But with that in mind, you still think we're starting to see signs of a Trump put as of yesterday? Maybe the Nasdaq closing higher is an indicator.
Anyone ever had a masala chai iced? That's what I have. Masala.
Yes, that's right. Markets are stretched to the downside because we lost, almost 13 percentage points in 2 trading days. As you know, it's almost like the stock market and the economy was delivered a heart attack from the terms of those tariffs. So I think that there is a bounce underway. Mark Newton, our head of technical strategy, views this as a technical rally. I think something that can take us, to recover towards 5,500 or something like that. But I do think that there is that, the challenge is going to be, we don't have a fundamental clarity and sort of the all clear enough for us to say that that's going to push us back towards new highs. So I do think we're kind of stuck in the near term, but yeah, I think markets overreacted to the downside. And yesterday, it does look like the messaging has switched. The president has moved towards to letting people know they're negotiating. And I think that's a return, or a quiet return, of the Trump put, because I don't think they want markets to continue to have this heart attack.
So you many times talk about your technical analysts, and a lot of times it doesn't involve trying to gauge what's going to happen with fundamentals or certainly not policies. But in this case, you got blindsided a little bit by something totally unexpected in your view for the size of the tariffs or the level of the tariffs. Why do you feel confident that we're in negotiation phase now, and tomorrow we might be back out of negotiation phase? You could get blindsided again. I mean, that would throw off your 5,500 target, wouldn't it?
Joe, that's right. One of the things we spent a lot of time talking to investors between Wednesday, Liberation Day, and over the weekend. And, it's clear to us investors feel that not only were these tariff levels absurd in the sense that it was very difficult for people to understand the calculation, but it really did break a covenant with capitalism. The idea that businesses need stable and predictable regulations. Many companies moved their supply chains in 2018 because of the need to move away from China. And now they have, potentially trillions of dollars of stranded capital again because of these tariffs. So I think that's the seismic shock that's very tough for markets and the trust that's been broken. It doesn't mean that we can't see a level of clarity that helps restore that trust. And so markets, after this waterfall decline, one scenario is a V-shaped bounce that takes us back to the previous levels. But the reality is it's going to, I don't know what that sort of clarity that's required for that is. So I think it does feel like this will take some time. And one very good friend of mine is Tom DeMark, and he says this reminds him of 2011. I think that's not a bad way to look at it, that it's going to take a little time for markets to regain some trust.
So this is hilarious because if you watch there was a video I did probably maybe 2 months ago, and it was either here on the reaction channel or on the main channel. I think it was here on the reaction channel because I react to a lot of Tom Lee clips and whatnot. And it was around 2 months ago, and oh my gosh, they were just loving Tom Lee. They were like patting him on the back. The comments so loving Tom Lee, right? And I told you guys, just wait. As soon as the market turns the other way, people are going to be dogging on Tom Lee. They're going to be hating on him. They're going to be talking trash about him, saying this and saying that. And sure enough, exactly what we're seeing now at this point in time. People are dogging on him, making fun of him, all those sorts of things. It's in a matter of 2 months, right? And so every time we're in a bull market, people treat Tom Lee like a legend, like, oh my gosh, he's everybody's favorite bull. And as soon as the market flips the other way, he's one of the most vilified people in the market, to be quite frank. And people make fun of him because I witnessed this before. 2021, people love Tom Lee. They loved Tom Lee then. 2022, oh my gosh. People had no respect for Tom Lee. They made fun of him. They said he lost all credibility, all those sorts of things, right? Then 2023 comes along and people start somewhat liking Tom Lee. They start kind of becoming a little indifferent. By 2024, especially late 2024, they're in love with him. A couple months ago, it's a blow off top. And then all of a sudden now, the flip happens, right? And all of a sudden people are doubting his credibility, and he doesn't know what he's talking about. He doesn't know what he's doing, right? It cracks me up in regards to Tom Lee. He just can be so loved in a bull market and so hated in a bear market.
But we did see, Tom, that huge roar back yesterday on the false rumor that suggested that
doubts. I think we're in serious trouble.
They were going to pause. The administration would pause for 90 days while doing this. So the market may have broken trust, but it's very eager and really hoping, it sounds like, for some relief to come from this.
Yeah, I think so. I think that there maybe were some, that's almost, if that was a trial balloon, it worked. It showed that if there was conciliatory actions that were sort of friendly to businesses, that the market could have a massive, massive move. The idea of like an exporter tax credit, these things really can restore confidence, because at the end of the day, the entity caught in the middle of this has been companies, and the capital that they've invested, they need to earn a return. That hurts shareholders, but it also hurts all the employees that work at these businesses. So I do think,
this really bothers me a little bit. These people, this whole notion about Trump has destroyed the markets due to his ego. I should have never voted for this guy. The people that are turning on Trump that voted for Trump is cracking me up. I was actually talking to my wife earlier. I said, if you voted for Trump, you should not be, if you're in your feelings about him, you were not listening to anything he said on the campaign trail, and you didn't pay attention to anything in the first term as well. If you know Trump, what were the main things he campaigned against? The same thing he's been saying for decades. Countries are ripping us off. We need to make massive changes here, right? Do you think that just comes along with the little teeny tariff here? No, he's going to make drastic changes. This is what he campaigned on. He's doing exactly what he said he was going to do, right? And so, like, if Trump all of a sudden was bowing down to Ukraine and was like, oh, I love Ukraine, we're going to send them hundreds of billions of dollars and do whatever, and he's like, it's okay, you can come over and be an illegal in America, and we're not going to kick the illegals out, that's fine, and you know what, we're not going to do the tariffs, then I could understand if you voted for Trump, you turning on him, because he's not doing any of the things he said he was going to do. The stuff he's doing is what he said he was going to do. Just because the market's going down now you're in your feelings, you didn't listen. You didn't pay attention. And I know some of these people in real life that voted for Trump, and now they're all mad at Trump. And I'm like, dude, did you not pay attention to anything that he said he was going to do? Like, I'm just like, come on, man, come on. Now you're going to turn on him? Like it'd be like voting for Bernie Sanders, and then being in your feelings because Bernie Sanders goes up on taxes, and you're like, oh, Bernie Sanders went up on taxes way too dramatically. It's like, did you not listen to Bernie Sanders and what he said he was going to do? And, you know, the whole notions and everything, like, were you not paying attention? Come on, man. Like, is ridiculous.
The ripple effects, you know, looking back, it does make sense why the market had a heart attack. But of course, this also means parts of this is very fixable, but it does mean that there is, you know, a bit of time involved.
I don't think the administration really planned that trial balloon the way that it kind of worked, but there's no doubt that they were paying attention. I would think it's like, wow, look what can happen in 5 minutes. You go from down 800. Let me just ask one other thing, Tom. So we negotiate with the 70 countries and we asked Scott Dustin about it. What if China becomes, you know, it's called a trade war, and the language we're hearing on both sides, it actually sounds like it could be headed for a war. So if we're, you know, if the Trump put involves the idea that we're negotiating with a lot of places and things just get worse with China, would that change your calculus on the Trump put?
Well, 7 countries represent about 70% of that trade deficit. You know, outside of China, I think the EU and Japan, Korea, Vietnam, you know, Canada, Mexico, I think we're heading, it looks like we're heading towards something that's acceptable to both sides. And really that leaves the U.S. in a better position. You know, I think there's a possibility that we don't ever resolve this with China. So, you know, there's going to be an attempt to maybe build the supply chain or isolate China. I think that's acceptable for markets as long as that's actually what's.
So we don't need a.
So I want to show you guys something very important here. So what I'm showing you is since the big day, Liberation Day, babe, April 2nd, I want to show you Apple versus Meta versus Amazon versus Google stock. What's very important about this is look at Apple. Devastated since Liberation Day, right? I mean, it's been nothing but liquidation day. I mean, the stock's down about 22% since Liberation Day, right? Why is it doing so horrible compared to Meta and Amazon, let's say, for instance? Well, Meta and Amazon have little to no business in China. Little to no business. So those stocks are not nearly as affected. Obviously, the market's gone down significantly since Liberation Day, so all stocks are going to go down. It's just Apple's gone down way more dramatically because Apple has so much production in China. Additionally, it's usually one of their best markets, right? You kind of look at Apple's business and you say, okay, the US is the main dog, then comes Europe, then comes China, right? And if we're talking about their Chinese business is going to tank over the next few years, whew, that's very negative. And then you look at Google and you say, my gosh, how is Google only down 7% roughly compared to Apple 22%? Well, gotta understand. If the Chinese are going to revolt and say, we don't want iPhones, right? Which, by the way, if I lived in China, I probably wouldn't buy an iPhone either because at the end of the day, there's a lot better options out there for you for phones than an iPhone. But the moral of the story is, what is the other option? Android. Who owns Android? Google. And then Google doesn't, I mean, their YouTube's blocked in China, right? Google search is blocked in China. So Google doesn't really have any like negative way their business can be affected by what's going on there, but they can be very positively affected if the Chinese say, screw Apple, we don't want anything to do with Apple, but we'll gladly buy Android, which is the only other option. If you're going to go buy a Xiaomi or a Samsung or whatever, they all run Android, which benefits Google. So now you can see like why Google stock has performed tremendously better since Liberation Day, and it's not even close versus a stock like Apple, right? And that's also why Meta and Amazon have performed better. So if you're talking about like who's benefits the most since Liberation Day, it's definitely Google out of that bunch of stocks, right? So, honestly, if the market wasn't down so dramatically, Google stock would actually be up right now significantly since Liberation Day. It's just when the market's getting brutalized the way it's been brutalized, right? I mean, let's pull up the Qs here and see how ugly it really is. If we pull up the Qs, you'll see here. So check out the Qs. The Qs is down like 12% since Liberation Day. So yeah, I mean, if the Qs are going down 12%, it's almost impossible to have your stock go up if you're in the Qs, right? And so, but Google's done far better. It's only down 7%. Negative 7% versus negative 12%. You'll take that any day of the week, right? So that's what's going on there. And Apple's in a tough position, man. And how they get out of this, I don't know. We'll see. Like they'll make it through, certainly. Apple will be fine long term, likely, but it's going to be a mess for Apple to deal with for a while. And then if we're talking about, oh my gosh, all these tariffs and what that's going to do for iPhone pricing, which is going to price even more people out of the market, which then gives Android a more competitive advantage because Android is a much more competitive market because you have so many different suppliers selling Android phones that they can't really price the way Apple prices their products. And so, once again, that makes Android more compelling, which benefits who? Benefits Google.
You here on a morning when we're still trying to make sense of what all these tariffs mean, Ray, and frankly, how all of this plays out. So to the extent that you can help us with the history, or at least a history lesson, if you think there are parallels, how does this play out?
Good to see you, Joe. Andrew, Joe, and Becky. I think that we don't understand how the cycle goes because it comes along about once in a lifetime. But there are orders, there are systems, and the systems break down for certain reasons, and it creates cycles. For example, there's a monetary system, and then there's a debt cycle. And so as a result, we now have, one man's debts, another man's assets. And when you build these up and you get to a point where you can't sustain that, you have a debt issue. We have a debt issue. We can get into that. But there's a monetary cycle. There's a internal political order cycle that takes us from one political order to another political order, in which there's then classically great turbulence between the left and the right. And because of disorder, particularly in democracies, there's a lot of fighting because there needs to be cooperation, compromise, and so on. And we're in the process of changing that order. In addition, we have the international world order. International world order began in 1945. There's a war. You win a war. The dominant powers get to set the rules. That was a series of multilateralism, things like the United Nations, World Trade Organization, World This and World That. And that multilateralism is then breaking down for unilateralism for the same reasons. So there are these three orders related to too much debt. Debt is money.
Look at how much the market was up earlier. That goes to show you like how big that flip was as some of that news came out of the White House, right?
Second, internal order. How does our system work? Who's going to get control of this problem? And then number three, in addition of the five main forces, there's also throughout history, climate, acts of nature. Droughts, floods, and pandemics have killed more people and toppled more orders. And then there's also throughout history, man's inventiveness and new technologies, which is creating this transformative result.
Right.
The interactions of these is what's going on. So if we look at tariffs represent a dealing with the imbalances. The imbalance means we have a tremendous capital imbalance and a tremendous trade imbalance, which is unsustainable. And so that's the backdrop of this. Related to that is also the international conflict. How do you have dependency, mutual dependency How can the United States be a safe country and not manufacture things and have to import them for China? Or how can China be safe in terms of having capital and American capital? Those connections are breaking down. So that's the essence of the backtrack. When we get into the tariffs, I'm sure we'll get into it.
Well,
but that's
Ray, that's a great backdrop to understand the way you're thinking about it contextually. But let's go straight to the tariffs, which is to say, how do you think, therefore, they play out? Is there, given the history that you talk about, is there the political appeal, either here in the U.S. or elsewhere, for these tariffs ultimately? And from an economic perspective, as we're all watching the market today, it's gotten a little bit better, but obviously, folks have lost 10%. Someone said to me last week, this is like a wealth tax, except that nobody gets the money. In that, 10% of a lot of folks' wealth vanished overnight as a function of at least this discussion thus far. So what happens?
Yeah, it's true. And, everybody's worried about how much revenue the government makes and those sorts of things, right? We're going to get out of this federal debt. Yeah, good luck with that. But, okay. Think about it. Like, where's a lot of the biggest money come from? From people making a bunch of money in the stock market, right? With capital gains. How much capital gains is going to be made this year from the government? Good luck, unless people sold stocks like I was, like back in January, right? And took a bunch of profits. Outside of that, people aren't going to be taking much for capital gains this year. Even if the market comes back strong, let's say the market bottoms here in the next month or two and comes back strong, still, there's still not going to be crap for capital gains this year, even if the market comes back strong. It would really be maybe the next year that you start having capital gains again. So, we could be talking about the government loses out on tens of billions or hundreds of billions of dollars of tax revenue. By the stock market going up and up and up, right? It helps out so many things. It helps out people want to spend more money because they feel better about their financial situation. So they say, I'm going to go spend more money. And that's, guess what? You go buy something. You're paying tax on that. There's almost anything you buy in this life, you pay tax on, right? And sometimes you get taxed many ways, along the road there. If all of a sudden people are not feeling good about their economic situation, then the government doesn't make as much tax revenue either, right? And then there's obviously not as much capital gains to go around, which means less money for the government. So which puts the government more in the hole. So yeah, something to keep in mind.
Well, mechanistically, it raises costs. It lowers revenues for companies. I mean, what does it mean for a company? It means costs are going to go up, revenue is going to go down, and capital is going to be harder to come by.
Oh, yeah, and there's another thing. If companies are making hardly any profits because their margins are being squeezed because of tariffs, then the government doesn't get to make all that massive amount of corporate taxes that they usually make, which they make unbelievable amounts of money of corporate taxes. Like, much of the revenue coming into the government comes from big corporations paying big tax bills. Like, even if a corporation is getting around the system and trying to use every loophole, still many times these big companies are still paying billions of dollars in taxes each year. Billions. If all of a sudden their margins are squeezed and they're hardly making any profits, guess what happens? Good luck with that tax revenue. You know what I mean? And so, yeah, you might tax them in terms of tariffs and they're going to pay all these tariffs, but then you're not going to get the corporate tax income. So you trade out one for the other.
And so, and then we're trying to replace manufacturing. I mean, I agree with the problems, okay, about the fact that we don't manufacture and that there is a problem with that. But there's a structural problem of whether we can manufacture. We have a
and that's a bunch of BS. This whole notion about the U.S. doesn't manufacture, it's baloney. Look at a company like Whirlpool. Many of their products are made in the United States of America. Look at a car company like Tesla. Look at Ford. Look at GM. They might have some plants in Mexico making some products or some plants in Canada, but there's a lot of auto workers in the United States of America that make cars in the United States of America. There's a lot of appliances that are made here, right? There's a lot of different things that are manufactured here. The semiconductor industry is booming out in Arizona. TSMC has built, basically facilities that are tens of billions of dollars. They have an insane facility that's about 15 minutes away from a house I own in Arizona. It's insane. This campus is ridiculous, how massive it is from TSMC. Additionally, Intel has built insane campuses. Like, the semiconductor industry in Arizona is going to be booming for the next several decades. which is, you want to make all these high-end chips here, right? Which is obviously something that's, very exciting. And so do we make jeans here? Not really. I mean, there's some, places in LA that will make high-end jeans or something like that, but no, it's not really a thing. Do we make the socks in America and the hoodies? No, not really. Do we need to make the socks and hoodies in America? I don't think so. I don't think we need to make them in America. I'm sorry, I think they'll be worse quality and be way more expensive if they're made in America. I don't think that's a good thing. Do we make all of our defense equipment in America? Pretty much. Do we make all our softwares in America? Yeah. These are all the important things that you want to make in America. That's the stuff you want to make, and that's the sort of jobs we want. I would much rather have people in America, creating unbelievable softwares for a company like Palantir versus, in a factory 10 hours a day making socks. Is a much better thing. I'd much rather have people working at semiconductor facilities making high-end chips than sewing hoodies. You know what I mean? Somebody else can have that opportunity. There's plenty of those opportunities out there, right? And you need to incentivize Americans to try to go after higher end jobs, more technical fields, those sorts of things, rather than working in a factory to make $25,000 a year. Also, we can all pay way more for a sock and pay way more for a hoodie. That's worse quality. That doesn't make sense. It doesn't make sense for anybody, just to be quite frank. To make 25 grand a year doing that? I'd much rather have the next generations be incentivized to rather work at a semiconductor facility, right? Or an auto plant, something like that. That's the stuff we actually got to be going after, in my personal opinion, right?
That basically 3 million people, 1% of the population, is incredibly brilliant. I mean, they go to the best schools, they come out, they make the unicorns, inventiveness. Half of which, by the way, are foreigners. And at the same time, they are making the unicorns. At the same time, what we have is 10% of the population around them that's doing very well. The 60% of the population has below a 6th grade reading level. And it's tough to be productive. So when we agree with the problem, too much debt, Secretary Bessent and others agree we should get it down to 3%. We have to get the budget deficits down to 3% of GDP. This is not, we all agree on the problem. The question is, what do we do about it? How do you create that self-sufficiency? And so from a practical point of view, that manufacturing is very difficult under this sort of circumstances to create within the United States, yet it's needed.
So therefore, you agree with the president? You disagree with the president? I'm trying to understand what the conclusion.
That's the most frustrating thing with Ray Dalio, is he talks around in circles, and he doesn't really ever put his foot in the ground. He just, and it's like.
If the president is watching you right now, if Scott Bessent is watching you right now, you're telling him what? This is a good idea? You're telling him abandon this idea? What are you saying?
I agree with the problem, okay? I am very concerned about the solution, okay? The practicality of the solution. In other words, I think that this is going to create not only the problem, the capital markets problem that I'm talking about related to prices going up, costs going up, prices, revenue going down, and capital problem. But I also think that this is going to create great sand in the gears of production worldwide. At the same time, I do agree that this interdependency, this issue of productivity in the world in which we have to be competitive and productive, and we're not competitive in producing things, is a longer-term problem, not an easy one. And I do expect that it is going to have political consequences. This is the nature of the cycle. It is coming also at the same time as we have a budget issue. Now, the budget issue is a comparably important issue. So as we look ahead in the months ahead, we have to get the budget deficit down to 3% of GDP. I worry about that at the same time as this is happening. These are not easy problems to solve, I'm concerned, because the bigger problems exist. The debt exists. You can't get around the debt. The overspending exists. You still have that. You still have that competitiveness issue. These have repeated throughout history. We're in a period that's very much like the 1930s.
Oh, bearish. So, the type of things you want to make sure you manufacture in a country, let's be very crystal clear about this. You want to make sure you have steel production in a country. Very, very important, right? You want to make sure you have as many raw materials in a country as possible, in that you have things like oil and gas, stuff like that. You produce that, right? You want to make sure you're able to make your weapons in your own country, right? In case you ever get in a conflict with another country or multiple countries, you better be making your weapons in your own country, right? Otherwise, you're going to be in a lot of trouble. You want to be able to make higher end things in your country, like semiconductors, manufacture those in your own country. You want to be able to manufacture higher end things like cars, homes, stuff like that, right? That's important stuff. That's a really important stuff that you got to always make sure you're manufacturing in your country. Cheap stuff like, socks and hoodies and stuff like that, a lot of that type of stuff, who cares? Who cares where the heck it's made, right? A little container, so a tomato plant can grow in it. Does it matter if it's made in Mexico or here? No, who cares? Come on, man. There's plenty of products that can be made in other countries, and that's just fine. It's not putting our country at risk because that other product's made over there. That's fine, right? You want to make sure our softwares are made in America, right? Because the world runs on software nowadays. If our software is being made all in China or Russia or, the UK or France or wherever, okay, now we got problems. But last time I checked, all the best software companies in the world are all in the United States of America. That's important. That's a really key important stuff, right? I like that Palantir is an American company. If Palantir was a Chinese company, might be in some trouble here. So keep that in mind.
Eisman Playbook podcast, which has dropped. It's a good listen, Steve. I listened to your first episode.
Well, thank you.
What do you make of this market here? You're saying don't be a hero.
What I make of it is that I think part of the problem, and I'm watching your show, everybody else's show, and people are getting on the show, they're all almost in hysterics. And I think the issue is that everybody of our social class took Econ 101, and we were all taught the same thing. Trade good, tariffs bad, trade war terrible. And that was drummed in everybody's heads with such force that it's a paradigm that now you have a president of the United States who doesn't seem to accept that paradigm, and people find that extremely jarring. So what I try and do in situations like this is try and step in the shoes of the other person, see the world through their eyes, and try not just to understand what they think, but why they think it. And I think what's going on here is you have to go back to the 90s when Clinton was pushing NAFTA and China entering the WTO. And he basically made two arguments: that free trade would improve GDP growth and would create a lot of jobs. And he was right on the former, and he was dead wrong on the latter. And, if you travel this country, there are parts of this country that would have been devastated over the last 25 years because of free trade, because they didn't just lose their jobs, they lost their towns. So I think President Trump is taking the attitude, free trade is great, but GDP isn't just a number, it's people. And there are whole parts of this country that have suffered terribly. And we have the freest markets in the world, and he wants to reorder it. And I have a lot of sympathy with that. And I think one thing that isn't said enough.
But it's also how you prioritize a country. We have prioritized the United States of America for really the last 25 years to really send our folks into fields like tech, to send our folks into software sector, right? Things like that. And what did we get out of that? We built the strongest, biggest, most powerful companies on planet Earth, like Apple, like Google, like Meta, like Amazon. The companies that run the world and are the backbone of the world are American companies. Now, we could have also took a standpoint of let's not incentivize that, really. Let's not go about that. We just want to keep things the same. Let's just make sure we keep making the sweatpants in America. Okay, forget about all this tech stuff. Forget about all this. No, let some other countries do that. What would have happened if we took that route? All the most powerful, biggest companies in the world would all be Chinese companies right now. we would all be buying all Chinese phones. We would all be using Chinese software on a daily basis. Palantir would be a Chinese company. Google would be a Chinese company. Meta would be a Chinese company. Like, that's what the world would have been. Would that have been better? No, absolutely not. Absolutely not. And so you gotta understand, like, how you incentivize a country is very, very important. So I understand the point he makes about some towns have been devastated, because blah, blah, blah industry went over to China back in the 70s and, never recovered. Fair point. But how do you want to incentivize a country? And so I think the United States has been incentivized very well in terms of getting people to go into this type of sectors and spaces and innovate in ways that they never would have done in the past.
Is that the United States, if that's your goal, the United States is in the best possible position to negotiate towards that goal, because the percentage of U.S. GDP that is composed of exports is only 11%. It's the lowest percentage pretty much of any country on planet Earth. Europe, every country is in excess of 30, except for Germany, which is over 40. Mexico and Canada are over 35%. China, if you factor in all the stuff that they do through Vietnam and Cambodia, is probably 30%. So what's going to happen over the next several months are negotiations, and what's going to become so if people are rational, this is where I don't know what's going to happen. If countries are rational, Canada and Mexico would come to the United States and basically beg, we'll do what you want. Because of the 35% that Mexico and Canada have of their GDP from exports, 25 points of that.
Why would they beg? If they have any sort of intelligence, why would they beg? The United States is going after almost every single country and putting these massive tariffs on almost every single country. So if you're Mexico, why do you got to freak out? Where's the United States going to go? Where are they going to go to manufacture this or that? Where are they going to go? They're putting tariffs on everybody like insane. So why do you need to panic? And that's just going to be a massive tax on U.S. citizens. Why do you need to panic? You're not. People think like the United States is in this massive position of power, and I'm here to tell you no, because of the way we're approaching it. Because if you went after one or two countries, then that's a whole different situation. Because then somebody like Mexico would say, oh boy, they're putting these massive tariffs on us. We better come down, because otherwise they're going to go to China and start manufacturing blah, 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 right? If China said that, and if we just were going after China could say, oh man, yeah, they might go from manufacturing this sector and this sector and this industry, blah, blah, blah. They'll take that over to Mexico. But when you're going after everybody at the same time, everybody's going to sit around and be like, what's the rush? Where are you going to go? Oh, you're going to start producing bricks in the United States? Okay. Who's going to do that for you? Where are you going to set up those facilities? Who's going to start that company? That's the game. And so if I was a president of Mexico, I wouldn't be in any rush, because the United States is not in the position of power. As a United States citizen, I'm here to tell you we're not in the position of power that is being cracked up by a lot of folks. Oh, yeah, United States. No. Because of our approach. Where do we go? Where we're going to go manufacture everything. They're putting the tariffs on everybody. Everybody's getting it. Vietnam, China, blah, blah. I mean, come on, man. Come on. Let's keep rolling here.
5% is just exports to the United States. Those two countries hold no cards. Now, Europe is not much better. And so I think if everybody's rational, they'll lower their barriers. Now, that doesn't mean everybody's rational. There's politics. People might be, some of the politicians might be afraid
Are we being practical? Come on, Steve Eisman.
And we're going to lose our jobs. Mm-hmm. That's the wild card. If reasonable heads prevail, Trump will get pretty much what he wants.
Let's say it's...
I already know Steve Eisman is insanely biased because of Israel and because of the relationship Trump has with Israel and the side that Steve Eisman's on. So you got to understand, like, Steve Eisman's insanely biased here, and I feel like if he didn't have such a big bias toward that whole situation, I think he'd be talking very differently about things right now. But he's extremely biased.
The truth is somewhere in between.
Which truth?
In terms of countries caving on one end or politicians being afraid of losing their jobs so they don't cave. Let's say they agree to some and not others. Is it worth the pain? In your view, is it worth the pain that we're going through in the markets?
To whom?
to our country, to the markets?
Well, there's the people in the markets who are upset that they've lost money. And I'm not going to kid you. I'm one of those people. I'm long only. I've lost plenty. But then there are the rest, everybody else in the country who lost their jobs in their towns. They're cheering. So who voted for the president? They did. So, I mean, look, you can agree with President Trump. You can disagree with President Trump. One thing I actually find extremely admirable about him is one of the few politicians in my lifetime who actually does what he says he's going to do. He has told you that he was going to do this for years, and now he's gone and done it. And everybody's shocked that he fulfilled his promise. They didn't take him seriously. But he's doing what he said he was going to do.
And that goes back to what I was talking about earlier. What frustrates me so bad, that people that voted for Trump, went out of their way to go to his rallies to vote for him, now are turning their back on him and saying, I'm mad I voted for him. I'm like, dude, he's doing exactly the stuff he said he was going to do. And now you're mad at him? Come on, man. Because the market's tanking, because the market's crashing, like he said he was going to do this stuff. And now all of a sudden you're scared?
Dan, it's good to have you back on the show, and that's exactly where I'm going to start with you. Given what we have seen, this downdraft in stocks, would you be a buyer here?
Well, it depends on if you're talking long-term or short-term, but right now I think over the short term, when I saw the market down this morning, I started going in and doing things like shorting volatility, where I thought we would hopefully see a pickup in a rally. Obviously, I wasn't expecting what happened intraday, where the market goes from being down 4.7% to up 3.4 and then back to, below flat. But I think it shows you that unlike prior drawdowns that
Apple just crossed an over 4% down move now.
In global financial crisis, you're not going to fix the problem in a day because you've accumulated tons of bad mortgages. You're not going to fix COVID because it's a global pandemic in a day. You're not going to fix the tech bubble meltdown because you overinvested for 5 years back in the late 1990s. This you can literally fix overnight if everybody, resettles the tariffs, because this is a self-inflicted wound. And I think that's what you saw with that move from down 4.7% in the S&P to up 3.4. And so I think what that does is it makes it so that in the near term, the path of least resistance is probably higher. Now, if you look long term, the one thing that brought me into this year, if you remember, one of my top 5 picks was cash. I had no Magnificent Seven in my top 5 picks. I was negative coming into the year before all of this stuff started to happen. And the issue was valuation, which nobody wanted to talk about who was bullish. And now everybody who used to be bullish is talking about valuations, which have dropped from 25 times trailing on the S&P down to 21. The problem I had was with inflation at these levels, the average S&P should be around 19 times. And so that's still another 10% lower from here. So I think the short term, I think you're going to see a bounce and you're going to see that continue. Longer term, I'm always focused on how much you're paying for things. And
so let's see how some of these other guys have done so far this year. Cisco. So Cisco was one of his other picks. And then he had, KBWB. Okay. Let's see. This is going to be interesting to see how these babies are done. The bank ETF. I don't think that's a good one so far. IJJ he has on here. IJJ. And then he also has ADTN as well. ADTN. Okay, let's see. And I think I accidentally deleted one on here. What did I accidentally delete? I think I accidentally deleted Amazon, right? And I think I accidentally deleted Google McDougal that I wanted to keep up there. Okay, so let's go ahead and take a peek. So Cisco, only down about 9% so far this year. So Cisco's actually hung decent. His ADTN pick is down about 13% there. IJJ is down 16%. And yeah, that's rough in regards to the banking ETF there. That one's down about 17.5%. So, yeah, I mean, Dan Niles seems to be pretty good, in my opinion, at kind of picking opportunities over like a 12-month span. I don't know how good he is at like long term, so thinking about like companies over the next several years. And I also don't know how good he is as far as making like very short term predictions, so like things over, you know, how the market's going to react over the next few days or the next few weeks. But he's been pretty decently successful in terms of kind of like 6 to 12 month calls. But yeah, obviously these ones are off to a rough start. But to be fair, the whole market is.
It's the thing that would keep me a little bit more cautious longer term.
So in light of that, let me play this soundbite from Jeffrey Gunlock, who was on in the last hour with Scott Wapner. Take a listen.
We have a lot of dry powder, and I talked about cash as a recommendation on Fed days for the past few Fed days, as much as 25 or 30% cash. I would not be deploying that cash yet. I think you're kind of in the middle innings of this thing, although certainly the market going down so much on Thursday and Friday, you know, it's a little bit disconcerting that we don't have more of a bounce in the market.
Sounds like you think we're in middle innings, or maybe middle towards getting towards the end, if you're talking about maybe another 10% drawdown here for the S&P. So assuming that happens,
yeah, I mean, let's be very crystal clear. If these gentlemen are correct in their assumption that we're kind of middle innings here, then you've got to be feeling like the S&P's got another 10 to 20% drop from here, which means stocks like Apple are then going to be down 50% plus this year. I just showed you Apple's already down over 30% so far. So that's basically making a call that a stock like Apple is going to end up being 50% plus down this year, right? Whew. That's making a call that, you know, QQQ will end up being down, you know, 30, 40% this year. That's a big boy crash. That's a big boy crash. I mean, you got to understand, in 2008, I'm trying to remember how much the market was even down in 2008. You know, peak to trough, if you look at the peak to where we peaked at in 2007 to where the very bottom was in 2009, all of the stock market indexes were down a little over 50%, right? But that was peak to trough. In 2008, even though the market got leveled, I don't even think we were down. I don't even know if we were down 40% on the Nasdaq that particular year, right? And 2009 actually wasn't even a bad year for the market. The stock market was actually green in 2007 and was green in 2009, believe it or not. The only year that was red was actually 2008. Now, if you look at the intra years, then, you know, like during the year you were down. But it was green 2007, green 2009. So 2008 was only a really bad year. These guys are talking about something along the lines of the great financial crisis. If you feel like we're only middle innings here.
I mean, we fall further. At some point here in the near term, we get even more washed out. Some of those technical levels are realized. Some of those valuation metrics that you just mentioned are realized. What would you be nibbling at first?
Well, I think it's very company specific. So I think, you know, there are certain names that I went into recently. But the big thing I would focus on is which companies are generating a lot of cash, which ones tend to pick.
Dude, once this video's over, I gotta buy AMD. Like AMD 79, give it to me.
Market share during recessions.
I have to.
Those are the types of names that you want to be in, because if you're in stuff where, well, you know, 10 years from now, it's going to be a big market, you're going to get absolutely murdered if you get into a recession. And so that's the stuff I would avoid, I guess, in that scenario. And don't forget, even if you go back to the global financial crisis, when the S&P was down 57% from peak to trough, you had 11 rallies in the S&P 500 of 10% each. 11 of 10%. And I guarantee you're going to get, or you can't guarantee, but it's highly likely, given what happened the last time, that you're going to have stuff like that happen again, and you're going to have the bullish analysts come out yet again and tell you how the market's going to be up 20%, trying to ignore valuations. But I think until you have the economy settled down, you want to stay in the cash generative names, profits today, not 10 years from now, where the multiples discount the risk. And I think the AI trade, now that you've reset some of these valuations a lot lower, those are some of the names you can go back and look at, and that's some of what we did today.
Oh my gosh. I mean, some of these stocks are just so insanely attractively valued. Whoa, HIMS is down to 25. Like a month and a half ago, 2 months ago, HIMS stock was like $70 a share, and now it's down to 25, just like that, in a matter of a couple months. Incredible fall. But I'm like looking at the possible buys watch list. Everything is Red Dead Redemption on there. Everything. URTY is calling my name. Oh my gosh. Whirlpool 77. Like, I mean, there's so many stocks I would love to buy right now. And like I always tell you guys, this is the worst part of a market that is in, that is crashing. This is the worst part. It's not about, like, at least to me, it's not about going down on positions. That's part of what you have to accept being in the stock market and being a long-term investor. Sometimes you're going to go through crashes and bear markets. That's fine. Cool. That's part of the process. The hardest thing for me is I'm looking out there. I'm like, I want that stock. I want that stock. I'm like a kid in a candy store. I want this stock. This stock's a crazy buy here. This is an insane opportunity. This stock is trading at what price? What? Come on, man. That's the hardest thing. Because I'm looking out there and I'm like, I want just about every stock right now. Like win 66. I want to win at 66. Come on. Trade desk is 45. Oh my gosh. SoFi's $9. Nike's 53. MU 65 for MU. Elf's 51. I got AMD at 79. I want AMD at 79. You're looking at Whirlpool at 77. I want Whirlpool at 77. It's insane, man. And that's the worst part of going through a crash is just you want to buy everything. And then you have to really focus because we all have a finite amount of money. You have to focus the money on the very best opportunities for the next 3 to 5 years. Man.
A so-called pivot at this point from the White House?
I think in the next few days, yes. It's hard to see how we'd have a big rally without some sense that this isn't going to be a prolonged trade war. The way I try to think about it is I think what's happened is 1 year of earnings growth has been already taken out based on lower consumer confidence, management teams not knowing what to do. So maybe my 2026 earnings are now my 2027 earnings. Maybe that's okay because so many stocks are down 15, 20% that maybe they're discounting that 1 year already. And so it's getting close as we tried to, you and I danced around the last couple of weeks talking about
15, 20%. In all due respect, sir, we're looking at stocks down 30, 40, 50, 60, 70, 80%, sir.
It's getting close. What I think is true, and then I got a little concerned I was wrong already, is that the tariff news wasn't going to get worse, that 34% number would be the biggest I was going to hear. And then while I'm in a meeting with a couple hundred people on today, I see a 50% number come across the screen, and I thought, whoa, so I think if the tariff news doesn't get worse, we can start focusing on earnings guidance and the stock action and maybe get to a brighter day later in the year. But I'm still too nervous based on what I'm seeing, today.
Torsten, it's good to welcome you to our program today. How does that match up with your own view?
I'll be honest with you guys. I got a dip. I need to go buy stocks. Like, I don't think I ever ended a video early because I got to go buy stocks. But, like, I can't look at EL at $49 and not go buy some right now. I can't look at AMD at $79, flirting with going to 78 right now, and not go buy some. Like, I need to go buy stocks right now, okay? Oh, my gosh. Appreciate y'all for joining me. As always, thanks so much for being here. If you're looking to apply, join my private stock group, private wealth group, get access to 1000xstocks.com, my private Discord chat, all that good stuff. Pin comment down there. You can click on that, fill out a form, see if you get you access to that. Oh, my gosh, there's going to be so much money to be made when we come out of this mess. But, woo-wee! I'm going to try to keep you guys informed. Much love and have a great day.